Hello, a warm welcome. I am Abhijit Bhave, CEO Karvy Private Wealth, and this video is about personal finance outlook for 2019. I will answer critical questions related to investments like the economic outlook for 2019, where are the Indians investing their wealth, the current key trends and the future trends. We expect the Sensex to treble by 2025 and we will tell you why. And finally, the investment outlook for the year 2019. When you look at the year 2018, two words come to my mind: less and lessons. 2018 was a year of lessons and a year of less returns. Amid the volatility, India stood tall. The world was moving up and down, but India reclaimed the world's fastest growing economy tag from China. For 2019, our expectation of global growth remains steady and about 3.5% for the coming fiscal year, which is good for investors. The headwinds like the trade tension between US and China, the Brexit, the slowing down of growth in China has been a concern. But recently talks are on between China and the US to resolve the issue, and we believe this would yield positive results. Also, this is an election year and we expect the market to be volatile. However, I would like to reiterate that market volatility always presents a buying opportunity and greater rewards. On the domestic front, India witnessed a growth rate of 8.2% in Q2, and we foresee a growth rate of at least 7.8% in the coming quarters. Post the general elections of 2019, we expect the structural reforms to continue and we expect the India growth story to continue rapidly. India will outshine its emerging peers in the year 2019. So let's talk about HNIs, the wealth of wealthy Indians. India is home to the fourth largest population of millionaires in the Asia Pacific region, and India is also the fastest growing market globally on HNIs with a 20.4% growth in the population and 21.6% wealth growth, as compared to the global average of only 9.5% and 10.6% respectively. Taking up the growth story, the total individual wealth in India grew by 14% to reach 392 lakh crores in 2018. The double-digit growth was attributed to a humongous 17.42% wealth growth in financial assets and a sober 9.24% wealth growth in physical assets. Financial assets today hold more than 60% of the overall individual wealth in India, the balance 40% being physical assets. The growth drivers of financial assets were: number one, direct equity, which emerged as the hero to capture the top spot with 21% of individual financial wealth, that is as much as 49 lakh crores with a growth rate of 30.3%. Number two was fixed deposits and bonds, which was at rupees 42 lakh crores, that is an 18% share in the total financial assets at a lower growth rate of 8%. We have seen a strong retail participation in India backed by the India growth story, and that has ensured that equity related other sub asset classes like mutual funds, insurance and pension funds remain on a strong growth trajectory. In that, mutual funds have led the pack, growing by as much as 34.5%. Unlisted equity grew by an impressive 36.83% and alternative investments grew by 33.5%. These two asset classes have a huge potential to become wealth creators in the coming years, considering the favorable macroeconomic factors and government initiatives like startups and infrastructure related developments. Among the physical assets, gold and real estate together constitute 92% of total physical assets. Let's talk of gold. The wealth in gold grew by only 8.85% as compared to nearly 4% last year, and this too was basically because of the price rise. Many people said that real estate is dead, but On the other hand, real estate has shown a steady growth of 10.35% this year as compared to less than 9% last year. Now let's talk about the future of wealth in India. By FY23 at Karvy Private Wealth, we expect the total individual wealth to reach 762 lakh crores, growing at an annual growth rate of 14.2%. Of this, the financial assets will grow at a much faster pace. They will double the wealth to rupees 518 lakh crores by FY23 at an annual growth rate of as high as 17%. Physical assets will not be far behind. They will grow at a slightly lower growth rate of 9% to reach 244 lakh crores. Let's now revisit the key events in 2018 which had a major impact on equity markets. Number 1, introduction of long-term capital gains tax. Now investors have to pay 10% tax for all sales of equity beyond 1 year, and that was a dampener. Number 2, US-China trade war, the big trade war, where hundreds of billions of dollars of import tariffs were imposed by both countries, and this was a threat to the world trade growth and the overall world economy. Third, and a big one, the IL&FS default, and that has caused significant liquidity issues for non-banking finance companies, NBFCs, putting pressure on lending activities of NBFCs, including housing finance companies, and having a negative impact on mutual funds, debt fund returns. Number 4, the farm loan waivers by state governments has been a concern and put a lot of pressure on the fiscal deficit. To add to this, this is the election year, and election year announcements could further increase pressure on the already strained fiscal situation. Number 5, the unexpected resignation by the RBI Governor, Mr. Urjit Patel, amidst tensions between the Reserve Bank of India and government on issues like liquidity management, NPA crisis, and usage of bank reserves, raised several questions on the autonomy of RBI, and investors are concerned. Number 6 was a roller coaster ride. Crude oil prices witnessed ups and downs in the year 2018, and the Indian rupee depreciated by more than 10% due to various global factors, and it remained volatile in 2018. However, as the year ended, it is now stabilized. Crude prices have cooled off, showing a positive sign for India. The Indian rupee has performed, mind you, much better than other emerging market currencies versus the US dollar. Now, let's come to Outlook 2019, where to invest. We are positive in 2019 on equity as an asset class. In fact, over the next 7 years, we expect the Sensex to treble to 1 lakh. Now, this we believe will be on account of 3 fundamental reasons, namely, number 1, earnings growth. We believe that earnings growth will pick up and it will be around 18 to 20% per annum over the next 7 years. Number 2, the consumption demand. The consumption demand will increase as more than 70% of India's population is under the age of 30. And this potential demand will convert into real demand in the future. And number 3, price to earning re-rating, PE re-rating for the Indian indices. Now, as the liquidity increases domestically and as we move towards a developed economy, we can expect price to earnings re-rating from the current levels. This trend has already been visible in the past couple of years. For 2019, we believe you should be equity overweight. That means buy more equity. So, our Karvy tactical asset allocation model suggests that a moderate investor may look at 60% equity, 25% fixed income, 13% alternative assets including gold, and 2% cash. For aggressive investors, on the other hand, the equity allocation may go up to 80%. Now importantly, for equity investments, one may choose any route like direct equity, mutual funds, equity AIF or portfolio management services. But the important thing is systematic investment. Systematic investment is the key for success in 2019. Instead of lump sum investment, one must look for a staggered investments. Now this helps in averaging of the cost of purchase in volatile times, and it is the best way to tackle market volatility in the short term. For mutual funds, our recommendations for 2019 are 50% should be large cap funds and 20% should be multi-cap mutual funds. Now, lot of quality large cap stocks have corrected 10 to 25% from their peak prices. After that, 20% for mid-cap focused funds, and finally 10% towards sectoral or small cap funds. Now, coming to sectors, at Karvy Private Wealth, we are overweight on banking and financial services industry, it's called BFSI, and manufacturing. Now let's talk of BFSI. BFSI will benefit as the overall economy and credit offtake picks up, and it has interlinkages with all sectors. Manufacturing has excess capacity and there is no capex required in the short term. This will lead to increased profitability in the near term. We are also positive for the long term and neutral in the short term for automobile and the consumer durable sectors, as the demand is subdued and the margin pressures continues. However, any correction is a great opportunity for buying into these sectors. Lastly, in our recently launched India Wealth Report, we also cover some contemporary topics. Number 1, Sensex to treble in 7 years, as we project Sensex to reach the figure 1 lakh by 2025. Number 2, in real estate, we forecast a rise in demand in specific themes like student housing, warehousing, co-working spaces along with pre-leased commercial assets. 3, international investments. International investments offer the right diversification to one's portfolio in situations like market volatility, wherein investments in developed economies offer better returns and stability. One also gets to leverage on dollar appreciation against the rupee. I am sure you will find reading this report and its finding interesting, and I look forward to hear from you. Do visit our website www.karvywealth.com for more details. Thank you so much for watching this video.